Look, for over 18 years, I've led JPMorgan Chase, and what I'm about to tell you might be the most unsettling truth of my entire career. I managed the financial collapse that happened in 2008, literally pulled the global economy back from the brink of total meltdown. I've even sat across from presidents. But what I'm seeing today pushes me to worry even more, because this time the danger's approaching silently. It's not even visible to the eye, and it's sitting right in your wallet at this very moment. Americans have $6.6 trillion in cash in their hands, and this money is losing value every single second that passes. Yes, you heard that correctly, exactly by the second. Even right now as we're talking here, the money in that money market account you think is so safe is melting away and disappearing, and you can't even realize this. I'm a banker. Yes, we collect deposits, we open savings accounts. But I feel compelled to tell you this. Holding cash in 2026 is financial suicide. Not crypto speculation, not meme stocks, not over-leveraged real estate investments, only cash. You're happy because you're getting 4% to 5% interest right now. But inflation at its real speed of 7% to 8% is destroying that money. Housing prices, healthcare expenses, education, food and beverage, and energy, all of these are showing faster increases than your interest rate. So in reality, it would be more accurate to say you're getting poorer at a rate of 2% to 3% every single month, slowly but in a guaranteed manner. I learned this in a painful way when I was starting my career at Goldman Sachs in the 1970s. Inflation hit double digits, and I watched the purchasing power of smart people holding cash evaporate and disappear by 30% to 40%. This happened in just a few years, in a dramatic fashion, and we're inside the repeat of the same cycle right now. What's worse is this. This time the inflation is structural. Because we use the dollar as a weapon, we broke global supply chains into pieces. We spent trillions of dollars. And most importantly, we learned that central banks will always choose inflation no matter what. Why? Because America's national debt has exceeded $34 trillion. Corporate debt has rushed to record levels. Consumer debt is at record levels. And with this much debt, there's only one way out: inflation. They're going to erode the debt burden by pulling down the value of the dollar. The Federal Reserve is having conversations about the 2% inflation target. But when reality reaches the door, when they're forced to make a choice between bankrupting the government with a deflationary recession or reducing the debt burden with inflation, every single time their preference will be on the side of inflation because they won't have a different option. That's why in such an environment, holding cash doesn't mean capital preservation. This is slow motion wealth destruction. For every single monetary unit you hold each month to meet your emergency needs, you're voluntarily choosing to get poorer. So what should you do in this situation? As JPMorgan Company, we are managing over $4 trillion in assets for our clients, and our recommendations for 2026 are very different from what most people would expect from a bank. We're telling our clients to be defensive, but we're not doing this through cash. We're teaching it through productive assets. Assets that create cash flow, that benefit from inflation, that manage to maintain or increase their value while currencies are losing significant value. The first category is dividend-paying stocks, but not every stock. Companies with pricing power. Companies that can raise their prices even faster while their costs are rising. Market leaders, strong brands, natural monopolies. Utilities, for example, can pass through energy cost increases directly to consumers. Think about consumer goods companies that can raise their prices thanks to strong brand loyalty. Or technology companies with software that businesses cannot give up. Within JPMorgan, we've identified around 140 to 160 companies that meet these criteria. What these companies have in common: they've been increasing their dividends continuously without interruption for at least a decade. They operate with profit margins above 15%, and they're positioned in sectors where entry barriers are high. These companies don't just preserve your purchasing power, they also enable it to grow in real terms over the long term. When inflation knocks on the door, they raise their prices, their profits increase, and they transfer these increased profits to shareholders through dividends. Compare it with your money market account now. When inflation rises, even if the number in your account stays the same, your purchasing power goes into decline. However, while these companies' costs are rising due to inflation, their revenues are also rising even faster and in larger amounts. The tables turn and you benefit as a shareholder. The second category is real estate, but not what first comes to mind like most people think. I'm not talking about buying rental housing and becoming a landlord. I'm talking about real estate investment trusts that own income-producing commercial real estate, meaning I'm referring to REITs, office buildings, shopping centers, warehouses, data centers, cell phone towers, healthcare facilities. We love and prefer REITs because real estate is historically one of the strongest inflation hedges. When living costs rise, rents also rise. When construction costs increase, existing properties become more valuable. And in addition to this, REITs are legally required to distribute 90% of their taxable income to shareholders as dividends. So you're obtaining capital appreciation along with regular income that adjust with inflation as property values increase. At JPMorgan, we have a real estate investment banking team that tracks large-scale REITs in the country, and the picture we're observing reminds me of the beginning of the 1970s, the situation right before the great inflation erupted. Property fundamentals are strong, but REIT valuations are still at reasonable levels because many of the investors are worried about rising interest rates. However, there's something most are missing. Yes, higher interest rates hurt REIT prices in the short term initially, but if these high rates are rising even more together with inflation, which is how the situation usually occurs, rents start rising faster than interest costs, and REITs actually benefit clearly from this. At a dinner I had with one of history's greatest real estate investors, I heard a sentence I'll never forget throughout my life. Jamie, when everyone fears inflation, be a borrower and own hard assets. When everyone fears deflation, be a lender and stay in cash. Then he added this, right now everyone is worried and scared about the wrong thing. He was right. People today are focusing on interest rates and worrying about them when they should be worried about currency debasement. While people are focusing on short-term price volatility, what they should really be worrying about is the silent destruction of purchasing power over the long term. The third category is international exposure, especially emerging markets in particular. I know what you're thinking. Emerging markets are risky, volatile. They experience political crises and currency devaluations. All of this is true, but here's what's also true. Many emerging economies have a younger demographic and faster GDP growth, and most importantly, currencies backed by real commodities instead of debt and promises. Under pressure together with the weight created by our fiscal irresponsibility when the dollar inevitably weakens, these currencies and these markets will benefit. At JPMorgan, through our private banking clients, we're quietly increasing our exposure to countries like India, Indonesia, Brazil, and parts of Africa, not because we have an appetite for political risk, but because we know how monetary physics works. When you print money without limits, eventually that money becomes less valuable compared to real things over time. And these countries produce real things: food, energy, raw materials, the things people actually need to survive, develop, and progress. The fourth category is precious metals. Before you roll your eyes, let me clarify for you that I'm not obsessed with or fascinated by doomsday scenarios. I look at gold and silver not as investment, but as insurance, a hedge against currency debasement and political instability. For 5,000 years, the picture has been the same. When governments have devalued their currencies, people fled to precious metals. Having our computers and modern financial system now doesn't change this reality either. But I'm not talking about buying gold coins and burying them in your backyard. I'm talking about precious metals, ETFs, mining company stocks, and what we call monetary metals exposure in the banking sector. Maybe this is around 5% to 10% of your portfolio. Not because you think gold will make you truly rich in the real sense, but because you understand that when confidence in paper currencies erodes, people flee to assets that cannot be printed. At JPMorgan, we own one of the world's largest physical precious metals vaults. We store gold and silver on behalf of central banks, sovereign wealth funds, and family offices. And the demand we're seeing is unlike anything I've witnessed during my 40-year career. This demand is coming not from speculators, but from institutions that understand monetary history. Now let me tell you how to put this strategy into practice, because knowing what needs to be done and actually applying it in a disciplined way are two different things. The first rule comes from being systematic. Don't try to time the market. Never wait for something called the perfect moment. Set up investments that automatically transfer money from cash to these productive assets every month. Dollar cost averaging is not only something that works in bull markets, it works even better in uncertain environments and periods as well, because you're buying more shares when prices are low, fewer assets when prices are high. Secondly, you shouldn't focus only on capital appreciation. You need to think in terms of cash flow. The goal is not to hit a one-time home run. It's to create increasing and sustainable income streams that grow faster than inflation. Every quarter compared to the previous quarter, you should be receiving more dividends, more rental payments, larger distributions. Real wealth is built only this way. This is your way to maintain your standard of living, regardless of what shape the economy is in. The third rule is being globally diversified. Don't put all your eggs in the U.S. basket. This is a serious risk. We represent approximately 25% of global GDP, but our stock market represents approximately 60% of global market capitalization. Making this sustainable in the long term is very difficult. Therefore, own European companies, Asian companies, Latin American companies. Don't think only in dollars, and also own currencies other than that. If possible, own assets in multiple jurisdictions. Fourth, you really need to understand tax efficiency. Hold your REITs and dividend stocks in accounts that provide tax advantages when possible. Use tax harvesting strategies to offset gains. If you're residing in high-tax states, consider municipal bonds. The goal is to keep as much of the returns you obtain as possible, rather than giving them back to the government. However, there's the most important thing, and a truth that my experience of having managed JPMorgan through multiple crises taught me that most people can never accept. You must be willing to be early. You must be willing to risk looking foolish in the short term so you can be right in the long term. In 2007, while many people were loading up on mortgage-backed securities and thinking the housing boom would last forever, we were reducing our exposure. We were choosing to look conservative. From the outside, we looked like we were missing the opportunity. Our stock price lagged. Even analysts were questioning our strategy. But there was one thing we were certain of. We knew that what cannot continue forever will not continue. And when the crisis rose up in 2008, we managed to be one of the few major banks that didn't need a government bailout package. The same thing is happening with cash right now in today's world. Everyone thinks cash is a safe haven. Everyone thinks the Fed is keeping everything under control. Everyone thinks this time is different, but monetary history never lies. When you create money faster than the goods and services you've produced, inflation comes knocking at your door. When your debt levels reach unsustainable points, currency debasement occurs. When your political dysfunction and fiscal irresponsibility increase, you lose your confidence in paper money. If you know how to read them, the signs are already there. Central banks around the world are buying gold at record levels. Sovereign wealth funds are diversifying by moving away from the dollar. Smart money is quietly moving into hard assets. Institutional investors, family offices, people who've preserved their wealth across multiple generations aren't holding cash. They're only preparing for what's coming. And what leaves me sleepless at nights is this. The average American family has no idea that this is happening. They're holding cash because their financial advisor said so. They're holding cash because they see the stock market as risky. They read somewhere that you need to keep your 6-month expenses liquid, and they interpreted this as keeping 6 months of expenses waiting in a savings account earning 5%. What we actually mean is not this. Liquidity doesn't need to be cash. It can be treasury bills held in the short term. It can be high-grade corporate bonds. It can even be dividend-paying stocks that you can sell if necessary. The key part is this. Your emergency fund should not be guaranteed to lose purchasing power every single month. I've gained enough experience in banking, enough to know that the biggest risks aren't the ones that make headlines. The biggest risks advance slowly, they are silent, and they emerge in an invisible manner. The risk of holding too much cash is like carbon monoxide poisoning. You don't feel and don't see that it's there, but month by month, year by year, it kills your financial future. And when most people realize what's happened, it's already too late. When they see they've lost 30% or 40% of the purchasing power of their safe cash, it's too difficult to recover. They're too old to take risks, too close to retirement to invest in growth assets. They've locked themselves into a declining standard of living for the rest of their lives. Don't allow this to happen to you either. Don't permit the illusion of safety to transform into the reality of poverty. The window to reposition your portfolio is closing rapidly. This is not next year, not the coming decade either. Right now, every month you wait. Every month you hold more cash than necessary is a month you cannot get back. This is not about getting rich quickly. This is not about speculation or taking crazy risks. This is about protecting the wealth you've already built. This is about making sure that the money you've saved by working throughout your life actually maintains its value. This is about financial survival in an environment where the rules of the game have fundamentally changed. The choice is yours. You can keep doing what feels safe, what everyone else is doing, and what conventional wisdom tells you. You can stay in cash and slowly watch your purchasing power erode, or you can accept that we're living in extraordinary times and they require extraordinary measures. I know what I'm going to do, I know what I'm doing, and I know what history teaches us about what happens to people who fail to adapt to changing monetary conditions. The real question is this: what are you going to do?